5 credit myths debunked today. Credit is always a hot topic, especially for first-time home buyers. After 20 plus years in the mortgage industry, I can tell you no question is a dumb question when it comes to getting a home loan. So today, let's go through the top 5 credit myths, and I think you're going to be surprised by some of these answers. If you pay to have your rent payments reported to the credit bureaus, does this impact your mortgage industry credit score? The answer is no. Oh my gosh, are you kidding me? No? Like, you're going through the hoops, it's all over the internet. Get your rent payment reported and it's going to improve your credit. It does, but not on the mortgage industry algorithm for the scores and the models that the mortgage industry uses. So why is that? Well, the versions of the credit reports that are used for a mortgage credit pull going through the mortgage loan process are very outdated, and they haven't been updated for years. Now, that is soon to change, but today these models are years old, which means that they were originated prior to this whole rental payment being reported to the credit bureaus. So the algorithms themselves for the mortgage credit pull have yet to be updated. So if you're paying for that, it could impact your other credit score models, but not your mortgage credit score. If you apply for a mortgage with 2 different lenders, 15 days apart, it will only count as 1 hard hit inquiry on your credit report. What do you think about that one? That is false. Why? Because there's so much conversation out there about it being a 30-day window. So in my scenario, I said 15 days. Why is that false? Because one of the 3 major credit bureaus out there that lenders use to gather data from when you go through the home loan pre-qualification process, one of those 3 credit bureaus has a 14-day window. Additional shopping or credit pull after 14 days will not impact 2 of the bureaus. It does impact 1, which could mean that it could change your credit score for the subsequent credit pulls after 14 days. Number 3, removing a medical collection account can actually cause your credit score to drop. It's true. Crazy, right? Now here's the thing, when it comes to collections of any kind, whether they're medical or non-medical, it's important to talk with your mortgage lender that specializes in credit analytics, because everybody has a different kind of scorecard. Think of it that way, a credit scorecard. And that's a real thing. There really are credit scorecards. So depending on your history of credit depth, credit performance, etc., it's going to decide where you fall in that credit scorecard. So even though it feels kind of counterintuitive, you think that you're going to go pay a medical collection and that you're going to have it drop off and that's going to increase your credit score dramatically, that may not be the case, but it could be the case. So it really depends on your particular scenario. Disputing third-party collection company accounts can help your credit score. False. Not on the mortgage-rated credit scoring algorithms. I know, again, it's something that's out there. People talk about it all the time, but it's not necessarily the case. Everybody has their own scorecard, and it is unique. It's kind of like a fingerprint. It's unique to you. So ensuring that you're talking with a mortgage lender that specializes and leverages credit analytics, we can actually go into your credit report and start to play with it and say, if this account is disputed, here's what happens to the score. If this account is eliminated or removed from your credit report, here's what happens to your score. I mean, it is so fascinating, but not all lenders do that or take the time to do that. So be sure when you're talking with a lender and interviewing a lender that you're asking that question if it's important to your credit scoring model. And number 5, closed revolving credit accounts can still be factored into your revolving utilization. Yes, that's true. Very often we'll see somebody that has closed maybe a credit card that's a revolving account, and maybe they have a $10,000 limit. They happen to owe $9,000, let's say, and then they close the account. That ratio of owing $9,000 versus the limit of $10,000 in this scenario, that's still going to impact the overall credit scoring model. And a lot of people just don't realize that if they close an account, they think that it's just done and over and it's not impacting their overall score, but that is just not the case. Closing an account, whether you owe money on it or not, could negatively impact your credit score. Again, always important to talk with your mortgage lender before you do any crazy things if you're thinking about buying or selling a home. When it comes to credit, don't try to navigate all of these nuances on your own, and you don't have to. Click the link below to schedule your personalized mortgage consultation with a KellyZitlowGroup team member. I hope you found value in today's video. I truly have a passion for mortgage education, and I would love if you would share this with somebody you know who could benefit from the information today. And make sure to stick around for my next video about the #1 mistake to avoid with your credit and tips to stay on track. Thanks for watching, and make sure you subscribe to this channel for more mortgage education.